Tim Quast is the founder and CEO of Market
My
Structure.
bushwhackers.
Dennis doing his dance. Tim, good morning.
Good morning, Spencer, Dennis, Joel. Good to see you guys.
Okay, props to Tim, who called us last 2 times on the show. He's saying, look under the hood, look in that market structure, and you can see that this market looks weak. Tim, absolutely right. That's what we are in here now. We need you to look under the hood once again and tell us if it's going to get weaker or if we're going to rebound here. What are you seeing?
Well, I'm reminded of a humorous line from W.C. Fields, and of course there'll be a bunch of folks on this show who are way too young. So I think I'm too young to know who W.C. Fields is. But if you don't know, millennials, Google W.C. Fields.
So as we right now, hold on, I don't know who that is.
As we think about the work from home trade, Spencer and Joel and Dennis, you guys were talking about this, and the state of the market, it calls to mind a line from W.C. Fields, who said that I spent half my money on gambling, alcohol, and wild women, and the other half I wasted. Meaning, I'm just kidding. It's just a funny line about what do you do in a market like the one that we have now. But we did, you're right, and I appreciate that, Dennis, that we talked about this last week for you folks who are regular to Market Structure Monday. And we were talking about, at first, the banks, which kick off earnings. And we looked at Goldman Sachs and Morgan Stanley, and we looked at the data, and we said, well, the data tell us not to expect very much, that they probably won't do well. It doesn't matter how good the earnings were, and both Goldman Sachs and JP Morgan, I think I said Morgan Stanley, JP Morgan did very well. The whole group did very well, but the stocks were weak. And we looked at broad market sentiment, supply and demand. The way that I think about the stock market is supply and demand. And it doesn't matter what the talking heads are discussing, or what the Federal Reserve is doing, or what the government does, or what the political situation is, or macroeconomics. If the supply-demand equation in the market doesn't match that rhetoric, then we will have trouble. It is no different than any other market. I saw Mike Jackson on CNBC earlier today. Great guy. I have a lot of respect for him, CEO of AutoNation. He's about to retire from that position, and he's always a straight shooting fella. He doesn't engage in hyperbole. He just tells you how things are. And he talked about, well, it was the 5th best quarter in company history for AutoNation, but he talked about the supply chain challenges. And one of the things that I hope Market Structure Monday does for traders is that it prompts folks to think about how there's a supply chain in the stock market too. There isn't just magically stuff to buy and sell. And we don't tend to think about that. We show up every week in the stock market and just suppose that somehow there's going to be the correct balance of supply and demand in whatever we're buying or selling, and it will move in our favor. Well, a lot of the time it doesn't, right? So it's just important to understand that. And I'm going to share my desktop because I'll answer this with a look at broad market sentiment, which is what we were talking about last time. So traders, if you want to follow along, go to marketstructureedge.com, and you can request a free trial. You can just put your name and email in, and you can follow along. We say that one of the 5 essential ingredients of good trading, it's easy step number 5 to us, is manage overall risk. You got to have a way to think about what the broad market is doing. Let me get rid of my face. I think you can see there. Okay, so I'm in the July 19 portfolio. But over here, there's broad market sentiment. This is our risk management tool. And we want to buy rising sentiment because we want to buy rising demand, and we want to sell falling demand. Generally, because that will generally mean, as a central tendency, that you're going to capture the gains. So this is broad market sentiment, and it's comprised of the 500 stocks making up the S&P 500 and the composite data for them. The SPX is a futures contract. People realize that. There's no underlying supply and demand that determines the value of SPX. It is implied demand in futures contracts. So we like to look at the underlying stocks because that's a better read. So if I expand this out a year, and this is again what we were talking about last time, that this dark part of the graph here, this is broad market sentiment, and it should wax and wane. Supply and demand come and go. And it's compared to SPY, which is a proxy, an exchange traded fund, oldest and largest, and it's a representative of the S&P 500. So generally speaking, when demand is rising above this 6.0 red line and then retreating and rising and falling, that's the waxing and waning of supply and demand that you would expect from people's fear and greed and indexes rebalancing and new money coming into the market and so on. When that trend begins to weaken, and look at the trend, right into about the first quarter, this was not bad. But ever since then, the the demand side of the equation has been weakening. And this has preceded every market correction. Look, I'm not saying there's going to be one. I could make a case that with sentiment nearing a bottom here as we with new options trading today. We want to talk about that briefly too, that there could be a surge. The old options expired on Friday, triple witching. There were index options that expired Thursday. Overall demand for derivatives declined about 1% last week. Well, it should be up. If people are renewing their contracts, we should see an increase in demand for derivatives that people use to take or manage risk. Well, they decline. Well, that then sets us up for a decline today with new options trading. It's like you show up at a farmer's market with all of your stuff to sell, and there are fewer people buying than what you planned for. Well, things will go on sale. And so then the Dow futures are down 500 points. But it may not be a good indication of overall trends or expectations for the economy or expectations for earnings. It is very contextual. It is about new options trading today and whether supply and demand are equal. Well, they're not. Look at this is where right now broad market sentiment is at 4.9, right there. If I move my cursor, it's going to move. But for July 16, Friday, it's 4.9. What is the nexus of supply and demand? 5. All right. So there is more supply than demand as we start the new week with earnings kicking off. About 300 companies report results this week, 1,000 next week. But don't think that this is necessarily telling us about that. It's telling us about supply and demand.
So we have everybody and a lot of people in the chat, and not everybody, but the majority of people probably looking at this and saying, down 500, what can I buy? That's that natural mentality of, and it's worked. I mean, it's worked well for a long time.
Right.
What do you tell them? You tell them to wait until you get above this 5 number. Yeah, you can be ready to strike, but you're not seeing the signal yet to come in here this morning and buy this initial dip here.
Right. I tell users of Edge, we send a daily market desk note, and I tell them they're basically, look, I want to make my returns in as little time as possible because time is risk. Time means things that I don't know and don't expect. So I don't like the 5 days around monthly options expiration. So that tends to be, tends to be Wednesday, Thursday, Friday, where there are VIX expirations, index options expirations, and then either triple or quad witching. And then the following Monday, that's today. Monday is new options trading. Tomorrow is what we call Counterparty Tuesday. All the banks like Goldman Sachs, Citi, Morgan Stanley, and JP Morgan are behind about 96% of almost, call it $700 trillion of notional value in swaps and various derivatives contracts. So they're going to true up their books. They're not concerned about making markets in equities at those times. So that then causes me, as a participant who understands these things, to say, well, maybe I don't want to get stepped on by that. Maybe I'll just avoid that. So this particular month, this is an off-cycle month where options expiring Wednesday are VIX expirations. So it went Thursday, Friday, Monday, Tuesday. Wednesday are VIX expirations. Thursday, we're clear of all of that. I don't like to trade in that. I have one position right now, and it's in real estate. And the reason I'm in real estate is because if I look at the overall supply-demand balance, and it'll take just a little bit for the machine to catch up here. So if I go look at the real estate sector, that's the only thing that looks good to me right now. If I look at real estate, it has rising demand and fairly stable supply in short volume. That's how we think of it. Demand, sentiment is demand. Short volume is supply. The only thing right now that I would look at retailers. I mean, no wonder they're down today. The demand is horrible and supply is just on an upward arc. Well, I'm not going to buy retailers, right? So I want to buy things where I have the highest probability of the proper supply-demand balance. Now, to answer your question about, well, what would I tell people to buy? Well, mind you, we're only data suppliers, but I look at what we call a liquid up portfolio. That's what I've got on the screen here. It's a dynamic portfolio that I give it instruction to go tell me all the stuff out there that has rising sentiment, constrained short volume, and at least $10,000 per trade of liquidity. I like liquid stocks because I'm less likely to get caught out in a meme stock sort of situation. Well, there are 6 companies in it. Under normal circumstances, it could be 100 stocks in that portfolio that are offering me opportunities.
What are those 6?
Let's go look at them, right? So, what are the 6 things to look at?
Tesla and Citigroup.
Actually, Tesla looks pretty good. Yeah, Boston Beer, KLA Corp. That's a semiconductor company.
Well, I can see the Boston Beer because we all drink more when we're depressed about our portfolio going down.
Right, it's a W.C. Fields strategy. He said during Prohibition there were several days where he had nothing to eat or drink but food and water. So that's another great W.C. Fields line. But there you go. That out of the entire market, notice that all of these have less than 50% short volume. The trend is up, and they're all below 5. Now, that doesn't mean that they are guaranteed returns, but the highest probability, there's your 6. That's it. That's all there is. And out of 3,400, there are about 2,600 companies in the Wilshire 5,000. All right. So out of all of those right now, that's it. Well, that tells us by itself, that tells us the market isn't great right now. And I prefer to wait for a great market. And the
how's
data
Citigroup in there, Tim? I'm just wondering how Citigroup's in there because it's making a new 52-week low here today, or actually not 52-week low, but a new low in the last 4 months. So I'm just curious, just to go and get into the the thick of your system here, how you can see Citigroup as potentially looking good.
Right. So here's why. There's one simple reason. The demand arc is up. This is price. So price is this one, and here's
coming in.
Yeah. So even though price is falling, the demand arc is up, and supply is right at trend. That by itself, to me, isn't great. It just says that's why the system says, here you go. Here's an opportunity. Now, if I look at the broader data, look, it's not spending very much time bouncing against the ceiling at 10. It spends a lot of time at or above 5. When it's not at or above 5, which it hasn't been since early June, see right here, about June 14th, options expirations in June. I'd like to be out ahead of options expirations. It's really not been great since. But that's why, Dennis. It's not. I'm not looking at this and going, "Wow, that's awesome."
Yeah.
See, that seems like embodiment of the overall market today as well. Well, doesn't look great, but compared to everything else, it doesn't look bad.
Right. It's a Winston Churchill line. Democracy is the worst form of government in the world, except for all the others. Right. And this is like these are good lines. It is a good line, right? So Citigroup looks, is the worst stock in the market except for all the others right now. Still not the one I would pick. If I were going to pick anything out of this group, I pick JLL because real estate as a sector shows a better balance. Plus, it's only 3% of the market. If tech is 27% of the market and it's weak, well, that's going to take the whole market down. Consumer staples, huge. It's 13% of the market. Consumer discretionary, about 13% of the market. Financials, about 14% of the market. So you look at all of these and you can only find one stock in them. That's not a great market. So my advice to traders right now is let's get through Wednesday, VIX expirations. I warned folks last week I did a couple of presentations. By the way, I'm doing a boot camp for Benzinga Saturday. And we're going to talk about why options expirations is something important to understand as a trader, that you can take advantage of the trends into it and avoid the dangers in it. But if this whole thing looks weak, well, let's just wait. Let's just wait for, if you're sitting out, then you don't lose money. You want to avoid losing money and use data to help you make money. That's the whole point, right? That's what we're trying to do.
All right, Tim Quast is the founder and CEO of Market Structure Edge. Come from the market structure, stay for the random historical quotes that we've never heard before. Tim, always a pleasure. We will talk to you again next week.
Good to see you guys. Have a good one.
Thanks, Tim.